I haven't been in Bitcoin all cycle. I've managed to outperform it via just having the right asset allocation. Yeah, bought Solana at the lows and then switched into Sui when it had its run, and it's given a bit back. But generally, that's worked fine. I'm not a big fan of going too far out the risk curve. Every time you think you're really being smart out the risk curve, your probability of success is pretty small. So I tend to stick with layer ones generally. And then, if I look at my wallet of shame from when I've allowed myself to FOMO in on stuff, I allow myself up to 10% of my portfolio to do that. I probably never even get to 10% because it's just not my comfort zone.
While most investors are worried about the cryptocurrency market crash, financial expert Raoul Pal has developed his own strategy for navigating the current situation. His approach involves increasing positions during price dips, taking into account the likelihood of sharp fluctuations in returns. Paul describes the current market as exceptionally tight due to the rapid liquidation of positions in tighter liquidity, amid growing concerns about weakening market makers' balance sheets. He believes the situation is reminiscent of past crises that, while initially alarming, ultimately led to similarly strong reversals. He calls 2021 when a 4-week correction reduced Bitcoin's price by more than half, with Ethereum and Solana suffering even greater losses. Subsequently, all three cryptocurrencies rebounded strongly and reached new highs. Previous cycles have shown similar dynamics, including the sharp 72% drop between 2019 and 2020 during the pandemic and a series of significant Bitcoin crashes between 2016 and 2017 that repeatedly shook the market before it rebounded. According to Raoul Pal, these are some key signals to take profit if you're holding Solana, Ethereum, Bitcoin. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now, let's get back to Raoul Pal's view on Solana and the overall crypto market.
What's happening to people is their time horizon shrinking and their need and desire for instant gratification is increasing because it's becoming harder and harder to buy a house or to have kids or do anything, right? So it's really shrunk people's time horizons and the instant gratification, which is why leverage and speculation are becoming a normal part of life now for most people. And so that makes it very hard to have conviction in something where you actually need the money to put a deposit on a house or down payment on a house or whatever it is. So you can't be risking all of that. So yeah, I own my houses, so I don't need to worry about that. So I'm in a stronger position. I get it. Mm. So you're either young, just extend your time horizon, just keep piling money into it over time. Or if not, you have to shrink your trade size if you can't sleep at night. Yeah. I mean, nobody likes it when their portfolio goes down 50%. But, if you're in crypto, you better get used to it because it's part of it. And as long as you're not too far out the risk curve, you basically have to say, is this thing I'm investing in, this network, is it going to survive? Does it have Lindy effects? And is it likely to grow over time? Yeah. If you can honestly answer that and prove it by showing some work that you've done that the network is vibrant, then you'll do fine. Primary importance is income. Yeah. It always is. And then you want to cover your Maslow's hierarchy of needs at first, make sure you can afford somewhere to live. And then depending where you are in your life, that percentage of your earnings that you put into your investments.
Yeah. Yeah. Charlie Munger said something great, which is rule number one, don't lose money. Rule number two, don't forget about rule number one. And then he also said, never interrupt the compounding. So if you can,
that people don't understand because they think don't lose money is like stop losses. I can't lose a single penny. I'm never going to have a drawdown. It's not that. Because you can't compound without volatility of returns. Right. And compounding actually requires you to buy at lower prices over time.
Paul stated that Bitcoin's traditional 4-year market cycle is now 5 years, and the next peak projected around the second quarter of 2026. His analysis links this shift to a structural change in global debt maturities, which lengthens the typical economic cycle by approximately 1 year. Paul explained that the maturity of government debt increased from 4 to 5 years between 2021 and 2022. He indicated that this change has effectively extended the global economic cycle, which Bitcoin's price fluctuations have historically reflected. According to him, the current trend replicates a 5.4-year sine wave, which corresponds to the weighted average maturity of global debt. Paul emphasized that the current cycle's delay is due to high interest rates, which have hampered liquidity growth. He noted that while Wall Street has benefited from asset inflation, the real economy has faced tighter financial conditions. He emphasized that lower interest rates remain necessary to control rising debt costs and restore balance between the financial and real sectors. The macroeconomic analyst also highlighted that global policymakers face a complex challenge, reducing interest rates to refinance growing debt without destabilizing currencies or inflation expectations. According to him, this context has led to a prolonged economic cycle, deviating from previous 4-year patterns. Beyond interest rates, Paul identified liquidity as a primary driver of asset valuations. He indicated that liquidity accounts for approximately 96% of price fluctuations in technology stocks and nearly 90% in Bitcoin. Furthermore, cryptocurrencies which outperform under these macroeconomic conditions could continue to be the biggest beneficiaries during this liquidity expansion. Paul concluded, however, that the cycle structure suggests that the growth momentum of Bitcoin and Ethereum could continue until 2026, and that liquidity will likely peak before mid-year. Paul's cryptocurrency investments are known for their strategic focus on major assets with strong growth potential. Historically, a significant portion of his portfolio has been allocated to Ethereum, which he considers a pillar of decentralized finance, DeFi, non-fungible tokens, NFTs, and Web3 innovation. He has often likened the Ethereum ecosystem to a rapidly expanding economy, making it a core component of his portfolio. Paul has also expressed admiration for Bitcoin as a store of value and hedge against inflation, though he has gradually increased his exposure to altcoins, reflecting his belief in the vast potential of blockchain networks beyond Bitcoin. Notably, Paul has invested heavily in Solana, a high-performance blockchain that he believes rivals Ethereum in terms of scalability and efficiency. By 2024, Solana represented a substantial portion of his cryptocurrency portfolio, reaching as high as 80%. Paul's optimism regarding Solana stems from its technical capabilities, its adoption by developers, and its ability to process thousands of transactions per second at low cost. His confidence in this project reflects his desire to refocus his portfolio on emerging assets with concrete use cases and dynamic ecosystems. He refers to NFTs as flagship assets, highlighting their potential to tokenize culture and community, thereby transforming intangible concepts into valuable, tradable assets. Beyond cryptocurrencies, Paul has diversified into digital art and NFTs, dedicating a significant portion of his Ethereum assets to high-value NFT projects. He views NFTs not only as investment vehicles, but also as cultural assets that embody the digital transformation of art and ownership. He points out that Bitcoin and other digital assets are growing at a rate of 150% annually, twice as fast as the internet, underscoring the rapid expansion and increasing acceptance of cryptocurrencies in the financial ecosystem. He is convinced that the growing wealth generated in the cryptocurrency market, coupled with the devaluation of traditional currencies, will generate strong demand for scarce digital assets like NFTs.